Everybody should invest in debt fund for stability of their overall portfolio. Kind of debt funds we have, it's almost a jungle. 16 kind of open-end funds. How do you navigate that?
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, debt funds get you higher stability, better liquidity, and might get you better returns than bank FDs. And they are ideal for risk-averse investors. But then there are 16 categories of debt funds, while you need only 2-3 of them for your portfolio. So how do you choose the one best suited for your needs? We'll tell you how to cut the clutter in today's episode. Stay tuned.
Once you have decided that you have to invest in fixed income, debt fund is essential simply because you get superior liquidity. It provides you enabling, beautiful deferment. You are not liable to pay any taxes till you sell your investments. If you invest in a debt fund and you keep holding it for 10 years, you are not liable to pay taxes. You will be liable to pay taxes only when you withdraw it and only on the gains that you have, only on the gains on that investment. Over and above, compared to any comparable instrument of similar character like fixed deposit or a bond or a company deposit, debt funds give you superior liquidity and potentially higher return. If you look at 5-year and 10-year return as a long-term investment vehicle for your stable allocation, they build a very strong case for themselves. Earlier debt funds were even more attractive because you could get indexation benefit. You invested in a debt fund, you held it for 3 years, and you could reduce your tax bill simply because it was adjusted with the cost inflation index. So only the return over and above inflation was taxable, or you had to pay taxes on that. That is gone. Despite that, I think the case for debt funds still remains very attractive. They are still the only option for people who want their money to be available on demand, but can well be a long-term investor. Yes, there are just too many of them. And they were supposed to simplify our life, and they were meant for individual investors. It was meant for the most, it's the simplest of need which people have. I have some money, I want to park it, and I don't want to take chances with my money. And then you go for a debt fund. And 16 of them are just too many. But we have chosen, in our premium service, we have a hand-picked list of funds which you can use for your long-term fixed income investment. I think most investors should broadly define or decide on their goal. Is the money needed for few days or few weeks? Don't go anywhere beyond liquid fund or money market fund. These are the only two categories. Your money which has to be on demand, and you don't want to any extraordinary return, but will get some modest return, and the money will be available and it will never go down in value. Then money for few weeks going up to a couple of years, but you might need it. For all those investors, medium-term investors, that you should consider short-term debt fund only. Short-term debt fund because it will give you relatively superior return, maybe ultra short-term, depending on, these are the two categories, short-term and ultra short-term. This is meant for all investors going from medium-term to long-term, simply because don't take chances with the fund which take a call on interest rate and the fund which take a call on the credit quality. These are two dimensions about which a fixed income investor should worry. There are funds which take, buy long maturity bond, a bond which will mature in 30 years, 20 years, and those bonds, they can be very wild when interest rates go up and down. There are funds, all these funds actually carry one of the two risks which is there with any fixed income. One is that mutual funds investing in corporate bonds, they can invest in lower rated bonds in their effort to earn little higher return. This is the kind of fund which might on occasion show higher return. Don't get attracted to it simply because it's just not worth your while. Many a times, these funds get volatile, and also they are faced with the credit risk. if a company is unable to pay its principal or interest on time, that part of your NAV will get knocked. And that is something which a fixed income or a debt fund investor is not used to. And so that risk is not worthwhile, though it does not happen very often. But even once in a while it happens, it could be a very painful thing, because we are not ready for accepting losses with our debt fund. Likewise, a long maturity bond fund. So those are the kind of fund which everybody should avoid. So most investors' need will be fulfilled with ultra short-term bond fund, liquid fund, and a short-term bond fund. That's it. That is where your needs end, and they fulfill most of it. If you want absolute safety, your options are liquid fund, money market fund, or deposits. If you just don't want to take any chance with this, or you're not conversant with it. But I feel that money market funds are superior to fixed deposit even in terms of safety. Sometimes they might yield higher return or lower return, little lower. But in terms of safety, they are higher than a bank deposit, simply because the money which is invested, the way it is invested in multiple banks, that is also spreading your risk. So on that count, I think those funds qualify as superior instrument than a single bank fixed deposit. Then comes, what is the kind of difference? Let's just take a comparison of, 1 year fixed deposit in State Bank. That will earn you 6.8%. And if you have a deposit of 1 crore, you will earn 6%, as compared to a short maturity fund where you will earn little more, 7.61 or whatever, about as much, close to 1% more. That this will translate into 80,000 rupees difference, which might be quite meaningful.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.